Good afternoon. My name is Toepfer with Primtek. Websites tell your story, web applications operate your business, and mobile apps keep you in touch. There's my 30 seconds of fame and commercial. I'm here to represent BRIG, Baton Rouge Industrial Group. We're a networking organization. Anybody ever done networking like we did here this morning? I love networking, and that was a fabulous way to warm this room up, and you got all these people talking. So my hats are off to whoever came up with that idea. I do it the old-fashioned way. I just go up and talk to somebody and say, hey, how are you? And I went up to Larkin Simpson, who was sitting by himself. I'd never met him before, and he told me he was from Alexandria, and I said, well, let's come meet some people. And he introduced them, and they kept talking. So that's why networking is such an absolutely wonderful thing. Baton Rouge Industrial Group meets once a month, and we've had up to 170 people in the room at one time. We talk about what projects are going on in the industrial realm, and we talk about how you get involved with those people and find where the jobs are and where the money's being spent, where the billions of dollars are being spent and where the millions of dollars are being spent, because that's where the POs are purchased. Now, there's a lot of interaction in our rooms, a lot of people getting POs because they keep coming back. That's because they're finding business and they're getting jobs from networking, just like what we're seeing here. So the supply chain of information is what we're dealing with. So what happens is you've been used to doing things with a 1, 2, 3 vendor. The world has shifted. The supply chain has changed. And your vendors for all kinds of services have changed too. So we're trying to keep them together. As the world shifts, you got to think about things in a new way, and that's what networking brings people together, and that's what Baton Rouge Industrial Group does. So today our moderator is Kendal Matassa, Vice President of Baton Rouge Commercial Banking for Regions Bank. And he told me his favorite thing is when he gets a project going for a customer, a client, and he gets to see that he was a part of building these companies' dreams and making things happen and building our communities with an economic base that will support us all. Because in the industrial world, we're looking for a healthy industrial living legacy so that we can have good communities and strong things that support our families and our kids and keep us all together. Kendal?
Good afternoon. So as we were gathering to get ready for this event, Chris walked over to me and said, you know, we're following lunch and it's towards the end of the day. We need to bring energy. And I'm like, gee, Chris, thanks for bringing this down to reality that we're about to speak. No, but I really appreciate his thought. And he did have a conversation with me because he wanted to throw out the traditional conversation in regards to reading a bio word for word, and you have to appreciate that. So I will try to do that same mantra here, but what I also want to do is make sure that I keep this conversation going and make sure that you walk away today with something to think about. So I think this conversation and this topic is very relevant. You can't turn on the news, open your phone, read the paper, and not hear something regarding supply chain, whether it's positive, negative, indifferent, or what have you. And quite frankly, maybe I just didn't pay attention, but it wasn't always that way. So with that being said, I really think that the timing is relevant, and hopefully we'll maybe bring this into the fold of the world of finance, which is not very sexy, but at the end of the day, it's definitely a part of your business plan. So as I said, the goal of today is to discuss access to capital and how to fuel growth and maybe some non-traditional banking ways. And we hope that you walk away with some ideas of maybe how you can use that in your current business plan. So I'll take a moment to stray off and give you a little bit of background or tell you about Regions, a little small commercial if you'll give me a second. Regions Bank is a full-service regional bank headquartered in Birmingham, Alabama. We have 1,300 banking centers throughout the Southeast and are valued a little over $150 billion in assets. Region serves both consumer and commercial clients. We have your traditional banking services, depository services, treasury services, lending such as real estate and working lines of capital, equipment and leaseback services, just to name a few of our core products. What we will focus on today are our verticals, and we've spent a lot of time over the past 5 years really working on building our verticals and working with the bankers to bring those solutions to our clients, because it's not something you're going to see in a 30-second commercial on the news or what have you. And it's events like this that we get to get the word out and maybe open up the opportunity for you to see other structures or other ways to access capital. Aside from consumer services, obviously we do commercial banking in that our non-traditional services focus on these verticals such as what Dan and Jesse are going to talk about today, and that includes foreign exchange, global trade, transportation, logistics, franchise. I say SBA because it also includes export working capital, and that is fairly relevant to the supply chain, as well as capital markets, real estate, and asset-based lending. And that's just a few. I don't want to keep all the time just for a big commercial. But today we have two gentlemen to my left from key segments that will support many of our supply chain clients regardless of the segment. A few logistics. I'll ask that you hold your questions to the end. That way we can keep the flow going, and then we'll reserve some time at the end to ask specific questions, or you can grab these guys after the event. So without further ado, let's get to the heart of the program, and let me introduce our first panelist, Dan Leonard. Dan's joined us from Charlotte today in our Charlotte market, but he services the entire bank. In that, Dan is Vice President of Transportation Logistics Group. He directs a team of strategic financial professionals and counsels corporate clients within our supply chain corridor. His experience in banking is built on a BA in economics from Wake Forest University and an MBA from Carnegie Mellon University. He holds a Series 79 and a Series 63 FINRA securities licenses. So I'll go ahead and kick off this session by asking Dan the first question. Dan, first of all, let's welcome Dan to Baton Rouge. So this is a softball, okay? So why don't you talk about, I know it's very broad, but really think about our audience and what we've talked about. Why is now a good time to expand your business?
Sure, and as he said, thank you all for having me. I appreciate it coming down from Charlotte. It's been a nice trip and change of temperature. So, and you don't have to hold your applause, so feel free. But yeah, why is now a good time? A couple of reasons. First, as we think about, and I'll do my best. Weston couldn't be here today, but as we think about corporate real estate, industrial real estate has really become the place to be in real estate market, and you're looking at probably values in excess of 20% of where they stood less than 18 months ago. So as you think about when's the right time to invest in for warehousing, distribution, cold storage, terminals, maintenance facilities, now might be that time. We have historic low cap rates, we have historic low interest rates, so when you've got banks willing to lend at sometimes 85% of LTV and those type of construction loans, that's a good time to invest in your business. When you think about the supply chain disruptions, whether it's the chassis or container shortage, or just in general the acceleration of the e-commerce secular tailwinds that have just, we've blown out every volume number you've ever seen. Now's a good time to invest in your business. When clients, and you see this on an everyday business, are trying to find capacity, whether you're a freight forwarder or you're an asset-heavier carrier, now's a good time to invest in your business. So very shortly, if you can provide additional services to your clients, and the bank can help you do that, and at what is a cost of capital to you or an interest rate decision, now's a good time. So hopefully that was the softball answer everybody was looking for.
Yeah, let me maybe ask one additional question that may be of relevance to the audience. How would you say, since you cover a broad market, how would you say Baton Rouge ranks in growth compared to the rest of our footprint?
Well, I think strategically it's very relevant. I would say in general, as we think about, and I sit with our corporate investment bank, so generally a corporate client, we would look at the market and it oftentimes gets sort of bumped with the New Orleans market, which may not be fair. Oftentimes it gets bumped with the energy complex and maybe what is the sort of Southwest Louisiana, Eastern Texas market, which is probably not fair either. But in general, I think access to strategic infrastructure is critical, and you sit at a nice inflection point between sort of a Houston, New Orleans, Memphis market that, as we think about growth, it's a very attractive place. And if you think about where investment has come in from outside capital, this is a place where I think investors can really come in and support the entire community. So I think overall, as a geographic area, if I were in Baton Rouge, I'd be very excited about the next 5-10 years of what was going to be to come, who is going to come in here, whether it's new or old, or who is going to be the real winner as they continue to develop Baton Rouge.
Thank you, Dan. I'll go ahead and introduce our next panelist. He joins us from our west in Texas, and his name is Jesse Riveron, and he joins us from our global trade group. I'll read his quick bio, and then we'll go into his question. Jesse is a senior vice president at Regions Bank Global Trade Finance Team. He has an MBA he earned at the University of St. Thomas. Jesse has been a trusted advisor to his clients seeking risk mitigation solutions, including supply chain finance, for over 30 years. I work very closely with Jesse, and he is very knowledgeable in regards to global trade. And generally, those types of conversations are very specific, and the solutions can go in a couple of different directions. Jesse brings a lot of knowledge and ideas to the table, and I'm very pleased to have him in Baton Rouge. So Jesse, I'll go ahead and start this by asking you the question. Can you talk about global trade solutions that can help companies facilitate cross-border transactions, and a little bit more specifically, maybe mitigation solutions?
Sure. Of course, Kendal, and thank you very much, dear audience. It's great to be in Baton Rouge, great to be back. I was absent of this market for the last 5-6 years and did work in other parts of the country. Yes, I've specialized in international banking and trade finance over the course of time that Kendal mentioned, specific to the subject of risk mitigation, cross-border risk mitigation, and how to facilitate cross-border transactions and how to ensure payments, how to ensure performance, both ways. For a company here in the United States, Baton Rouge-based importer, for instance, and vendors, wherever they may be, the counterparties, and the contractual engagements that they would have completed. So the simple answer to that question, though complex when implementing and crafting, advising around this, is the use of commercial or standby letters of credit. Commercial letter of credit, for instance, would work toward assurance of performance by a vendor who would be the beneficiary of that letter of credit, who would not get paid unless that beneficiary would meet every one of the conditions in that letter of credit. Simple, short answer. Yet, again, complex to implement and to put in place. What I mean by that is this. A company issuing a commercial letter of credit would need to be a credit client of the bank. Regions Bank, in this instance, and I should reference the fact that Regions has been in the trade finance business, the global trade finance business, for 100 years. So it's a core competency line of business with a major regional institution known around the world, with correspondents in many parts of the world, and known in that regard. The other type of letter of credit that I mentioned is called a standby letter of credit, which likewise can help support international trade, can help ensure that performance on the part of the beneficiary. Requires as well the delivery or the approval of credit. Credit would need to be underwritten, just like in the other case. But then there are other solutions that are very important in general with regards to supply chains, whether domestic or global. And that is one of working capital financing. So there are two options, if you will, in that regard. One, as Kendal addressed earlier, would be under the auspices of the Small Business Administration, and that is the SBA's Export Working Capital Program. That program has certain limitations. Many advantages in that the products exported from the U.S., and this is a major and very distinct feature in this program, do not have to have U.S. content. So this was a Baton Rouge-based company selling, let's just call it Taiwanese assembled computers to a country approved to do business. What I mean by that is the Export-Import Bank, and I'll come back to that in a moment as to what that Export Credit Agency of the United States does and how they do it. But they much, based on the diplomatic relationships of the United States, dictate what countries are open to do business and which ones are not. But back to the SBA solution, again, products that are not U.S. in content can be financed under this program, where the lender would receive a guarantee by the SBA of 90%. The advantage to the exporter using this program, the borrower using this program, is that those receivables or inventory, which is be receivables with a foreign name, inventory that's destined or earmarked for a foreign market, work in process, are all financeable assets that traditionally, under a typical commercial, revolving line of credit by any bank, would likely be excluded. So great advantage. The limitation that it has is that you cannot borrow more than $5 million under such program. So that takes me to the solution offered by the U.S. Export-Import Bank. That program is called the Working Capital Guarantee Program. There is a requirement of a 50% minimum U.S. content in the goods being exported, but the credit facilities can be for greater amounts than $5 million. There, too, advances would be against receivables to the tune of 90%. In this case, the receivables could be of up to 90 days past due. In terms of the eligibility, the guideline by the Ex-Im Bank to lenders such as ourselves, where they wouldn't be considered past due necessarily. You can advance up to 90% against receivables that are up to 90 days past due, as I just mentioned. For inventory and work in process, the bank can advance up to 75%. So great source of liquidity in both of these programs that can further support, foment, expand export sales. I'm happy to share the following. Regions Bank is a leading bank in the United States in the delivery of the SBA program, the SBA Export Working Capital Program. No other bank comes close to Regions Bank in the origination, structuring, execution around this particular solution. On the Ex-Im Bank side, Regions is a significant provider of the solution. Last year was awarded the Export Bank of the Year by the U.S. Export-Import Bank. I've been to many of the annual meetings that the Ex-Im Bank holds. That is a global audience. It's not just U.S.-based exporters, U.S.-based bankers, but it's really a global event that occurs in Washington, and it was a big recognition. I don't take any credit for this because I joined Regions Bank in August of this year, but it's great to be with an institution committed to the business and with the ability to execute and support businesses, maybe like many of yourselves, that would be happy to chat with later or at the Q&A session. In terms of foreign exchange, I'm not a foreign exchange specialist. We have a team that we partner with, both our commercial bankers, such as the ones here in this room today, and ourselves on the trade finance side to advise clients around the best hedging strategies, the best way to really bid for foreign order. It's not always saying, hey, look, I need for this to be in US dollars, where that buyer overseas could say, well, let me turn to a European vendor of the same products who's willing to quote their sale in my local currency. Makes it easier for me to import from the Eurozone. It might be easier for me to import from the US if you cut the deal with me in my local currency. Well, there's a way, certainly with the use of the expertise of, say, the foreign exchange team at Regions Bank, to ensure that when the payments are made in that foreign currency, they're converted to US dollars in such way and prepared way in advance that the preservation of profit margins invariably will be there. So the foreign exchange risk can be mitigated as well. That's a general statement. I would say if there's an opportunity to bid for an export sale, think of that. You can still ensure your convertibility to US dollars and make you a more competitive proponent of the deal if you quote in both US dollars as well as the the indigenous currency of the location of the buyer, of the counterparty.
Thanks, Jesse.
Sure.
So as you'll see, we actually have an empty spot, and one of our speakers had a change in schedule. So Dan has graciously agreed to take his question. So I'll go ahead and let's go back to Dan. Dan, if you could, I'd like you to maybe speak to real estate and more specifically build to suit or sale leaseback options that could be another source of capital.
Sure. So, I think it goes back and ties nicely to the first question, is why is now a good time to invest in your business? So when you think about and you're making a decision around own versus lease versus build yourself and project manage through execution of that build, why would you use a third party to support you in that effort? So, the first is what is the best use of your capital? Historically, capital invested in real estate has returned roughly 2%, in line with inflation. That's a little bit, I would say, off in today's market, as I mentioned, given where real estate values have gone specific to the industrial complex. But in general, if you're okay with 2%, then own makes a lot of sense. But when you think about an elegant solution around having somebody provide the upfront capital so that you can match your revenue to your costs, which will eventually be the lease expense, a build-to-suit solution or a sell-leaseback can make a lot of sense. So why would you do a sell-leaseback? Well, as I mentioned, if you're sitting on a property that has 20% accretion in its current value, and how much further can you, or do you anticipate that value or residual value to grow, you may want to exercise that sale today. But you may not want to move. It's perfectly, you want to manage and stay in that location. Well, sell-leaseback, you can sign a 10, 15, 20-year contract. You can recognize that gain today and invest that in the growth of your business. So it makes a lot of sense for companies that are sitting on sort of large value due to the last couple of years of sort of value accretion in that business. So what can a build-to-suit solution look like? Well, you want to focus on your core business, and if you're a 3PL, if you're a trucking company, managing a construction project and the relationships and construction management, that's not your business. They're partnering with Regions. We have a 50-year relationship with a company called Stonemont, and there are others like Stonemont out there that will provide passive capital, upfront capital. It preserves your liquidity, it preserves your balance sheet up front, that then they'll go through the permitting process, the construction process, the design process, everything from start to finish to your needs, and then you sign a 10, 15-year, 20-year lease with no capital outlaid until the project is completed. So a built-to-suit can be a very elegant solution for a company that is looking for maybe an addition to a current property, or to move a terminal or a cold storage, for example. And as you think about what the right, if you like to own, typically those leases can have sort of early buyout options. There are all different structural terms that you can create that will give you the flexibility if you have some consternation around, we typically like to own our own real estate. I would say competition for real estate right now, given the behemoth, which is Amazon, but others in the market for industrial real estate is huge. So, taking some of that residual risk off your balance sheet and using a partner to help you do that can be a great option. As I think I already said as well, cap rates are historically low, so it's extremely attractive. And then it gives you the flexibility to determine matching what your investment's going to be, and then linking the revenue that you're going to earn from that investment to the actual cash outlay on the front end. So hopefully that's a succinct answer to sale, leaseback versus ownership versus built to suite. But it's a little bit unique to every situation. So happy to re-engage elsewhere or afterwards, but also introduce you to Weston if it's appropriate.
Thanks, Dan. So this is the audience participation part. Are there any questions from the audience? Do we have microphones to go around? Yes.
Have you seen any changes over the past few years to the number of letters of credit? I guess this question is specifically for Jesse. Have you seen an increase in the numbers of letters of credit that you've seen over the past few years or so?
The answer is this. The use of commercial letters of credit declined up until the pre-COVID period, right? And certainly during the pre-COVID, 2020. Has it picked up? Has the converse of that taken place certainly this year? The answer is absolutely yes. Just this morning, we had a call with an importer that has never used commercial letters of credit, so there was a lot of discussion around that. At the end of that meeting, the end of that discussion was one of an advance. In other words, to continue the conversations and to hopefully arrive at an agreement such that would enable this company with additional working capital to support their growth, while at the same time having an import LC program in place as an option, and a solution when needed for specific vendors that are in their network of purveyors, some new, some existing of many years. The challenge of supply chains affects parties in both parts of the world. What I'm referring to this is not only the U.S. as importers, but exporters in the traditional countries today, which would be China. There's a capital constraint there as well. The ability by these companies to source raw materials to ensure that the assembly and fabrication of products will occur is a challenge these days. It's not smooth sailing like it was. So the use of a letter of credit, in this case a U.S. bank letter of credit, advised and dealt with on that part of the world through their bank, can be used as leverage to obtain financing for that working capital. So that's why there's been an increase. That's commercial letters of credit. On the standby LC side, I would say there's been some increase as well.
Thank you, Jesse.
Sure.
I've been told that infrastructure and transportation financing is one of the most sought after in the investment world right now because of the returns, but the consistency of returns. In your traditional type banking relationship and competitiveness against Wall Street type money coming in, are y'all seeing that as a big competitive situation going on between quote unquote Wall Street type money versus conventional banking money in the infrastructure / transportation field?
I would say they go hand in hand. I don't think it's competitive. I think it's more, it depends on what side of the transaction you are. If you're the client, you are benefiting from that influx of capital. Infrastructure funds in general, and Wall Street money in general, have a longer tenor and a longer expectation of hold. And so the typical relationship that they might have with their investments and that you might have seen in a sponsor world or in a private equity world is mitigated by that, because it's more evergreen capital. So I don't think the bank looks at it as a competitive way. I think there are opportunities for the bank, whether it's our commercial partners or our corporate partners or our geography, to participate as relationship with that organization and with that company, while also utilizing Wall Street or infrastructure fund money. And that's why it's not necessarily competitive, but certainly there are those funds, and Wall Street money can go further down the risk chain than what your typical bank is willing to do. But that has consequences as well. I mean, the cost of capital and the cost of that dollar is higher. So it's depending on the situation, but I wouldn't say it's competitive in a bad way. I think there is a place for the relationship banker, there's a place for your bank and your banking partner and Wall Street money.
Thanks, Dan.
There's a lot of saber rattling going on right now in the Far East, upsetting a lot of people. As international financiers, how do you see in the future companies that want to do either international trade with the Far East or have an America First policy? Which are you more likely to support, and or if it's equal, do you put more costs associated with the upcoming issues that we're having with China that seem to be only growing in the future?
So the answer from a banking perspective, from a commercial banking perspective with international banking and trade finance expertise, is this. Our work in these different foreign locations is with correspondent banks. Correspondent banks evaluate us as much as we evaluate them. And we also look at the geopolitical landscape, always, and the extent to which that financial performance of that particular foreign correspondent bank merits for us to continue to support, and that would be because the geopolitical landscape is stable, we will continue. If the financial strength is there, but the geopolitical landscape is not where we need it to be, and we have very specific models that we follow to make the determination, we may decline to continue and maybe resume later. And in the world of international correspondent banking, it happens that way. You can cease and return both ways.
I'd add that and because I think you said sort of the company model, whether it's America First versus international, I think not necessarily our bank alone, but the way it's viewed from a credit perspective when you're thinking about the landscape of the deal, or if it's let's say a corporate revolving type relationship, is where are the assets, what's involved if we had to prefect on those assets, and whether it's America First or international, what would be the steps if we were having to go and collect on those assets. So less about an America First or international, but more about what would be the process to protect the bank's obligations as well as your own. And so it would be in combination what Jesse's talked about and that discussion in the specific product.
Yeah, I'll add this comment. The intention would be to expand from a multinational perspective. In other words, you're a U.S.-based company, you're thinking about establishing some level of corporate presence in a foreign country. You know, there's the Overseas Private Investment Corporation, which is a U.S. government agency, which is definitely worth consulting and seeking their direction and potentially their guarantee programs to ensure preservation of that corporate presence to be had in that foreign country.
Let's maybe give this one to Dan. What distribution and manufacturing industries or maybe transportation logistics industries are more attractive to banks?
Yeah, that's a great question. I would kind of make it more general. And as I look at, what's an investment highlights page look like, if I were on the client side or the customer side, what would I be saying and how I'd sell my business? The first is going to be, what's my competitive advantage? Why do clients come to me first? At the end of the day, if it's your service, if it's your strategic location, if it's your ability to do something faster, better, or at a lower cost than a competitor. The second is going to be contractual relationships and contracted revenue. Banks are going to love contracted revenue. What's the right mix? I would tell you, especially in what is the sort of warehousing and distribution market, if you're playing in any type of spot rate, you're probably benefiting today. So if you're 100% contracted, you're not going to be able to recognize the gains that we've seen in sort of spot pricing, whether it was against commodities or trucking. So that is important. The length and tenor of those relationships. So contracts are great, but if every new contract is for a new client, the bank is going to dig in a little bit more. So you want to have new growth, but you also want to have 10, 20, 30-year established relationships. You want to be attached to industries that are either counter-cyclical or they have some type of mitigant to cyclicality. So if you're looking, I've said it a couple times today, but cold storage is probably the hottest market that we're seeing. And whether it was, to your question, Wall Street money or sort of older dollars and where they're investing in warehousing and square footage, why is that? Well, if you think about what needs to be stored in a cold storage facility, the need for foodstuffs and food good products, it doesn't change whether you're in COVID or in a 2008 scenario. So it's a much more stable business. And so how can you win in an environment for cold storage? Well, the operating risk for cold storage is probably much higher than a lot of people recognize when you think about it. If you mess it up, your significant liabilities on the back end, millions and millions of dollars of lost goods. So you can be a real winner if you can provide services that are just unmatched. So you can build thousands of square feet, but if you can't run the business in a manner that supports the customer and prevents loss or leakage, that's not a winning scenario. So it's a combination of relationships, growth, development. It's not necessarily, you don't have to be only exposed to food good products. You don't have to be only exposed to construction. The energy complex is more difficult. I think that's probably not unique to Baton Rouge, and in this market everybody probably knows that. So it can be difficult, but if you layer on the strength of your relationships and the competitive advantage that you maintain, the banks can get more and more comfortable.
Thank you.
I have a follow-on to that. In the third-party logistics world, there's contract warehousing. I build a building, and you agree to use that building and pay for it wall to wall for however many years.
With the take or pay.
Well, that's right. They're leasing it. In a public warehouse model, you might have a contract. It defines what you're going to do, and it defines what you're going to cost, but it doesn't define how much business they're going to give you.
Right.
Right. So it's the pay for what you need, only pay for what you need model. And when we've done financing in the past, it's very hard for the banks to understand that model, or at least it doesn't give them that reassurance. You go in, I want to borrow money to build a building. You said, well, who do you got to lease it? You said, well, nobody. You said, well, how many square feet are committed? Well, none. Actually, I have business, or I wouldn't put this up. And but my customers have committed to last month, and that's it. they haven't committed to this month, never mind next month. It's whatever they produce and they send to me. And so what I really need to know is how do I get the 85% non-recourse loan?
Yeah, I'd like that too. I'd love a bankruptcy remote loan. Yeah, that's a great question. I would say, that's where managing your relationship with your banker and creating a strong relationship with your commercial bank is so critical. I think there's always a sense of bankers and the balance sheet that banks can provide is a little bit of a commodity, but not when you're looking for that type of loan. And so when you can tell the story, whether it's 30 years and whether it's Wilson Warehouse and here's what our growth looks like, that's when that type of loan at that LTV with those structural candidates become an option. Now, if you reach out to a bank that you do no business with, who you've only called twice or at least entertained a discussion with, it becomes much more difficult. So that's the first answer to that. The second is I would go back to a build-to-suite type solution can be a really elegant answer to that because you're getting 100% up front and you're providing no capital. So when you partner with someone like Stonemont or a JV or an outside partner who's providing the upfront capital and then having the lease on the back end, you've effectively made 100% LTV loan with no costs and very similar contractual relationships, and you can build in the linchpins around if you want to own versus future ownership or sale. So that's hopefully that gets after your answer. Are you giving me a PG too? No. Then it wouldn't be.
All right. Well, I thank you for your time today. I did miss something earlier that I want to circle back to because, Dan and Jesse joined me up here, but I don't want to have all the fun. So I want to take a moment to introduce my colleagues that are here from Regions Bank. And if they'll please stand, Audrey Smolke, Chris Sullivan, Katie Graves, Mike Breeden, and Amy Province. Thank y'all. They're giving me the look. I'm sure I'm going to be in trouble for that, but didn't want to have all the fun. So I really thank you for your time. I hope you got something out of this. Like I said, it's not exactly the funnest topic, but I think we moved it along fairly quickly and stayed within time. I did mention that Jesse and Dan will be here for a little while after. If you want to ask a question that maybe you want to ask in the audience or what have you, or in front of everyone, feel free. But with that said, this concludes today's program. Thank you.